Hello, this is part 3 of the Chapter 8 lecture series on notes receivable. Let's get started. The second type of receivable discussed in Chapter 8 is notes receivable. A promissory note is a written promise to pay a specified amount of money on demand or at a definite time. We are essentially giving someone a loan. An important thing to remember is that we will not receive anything until the maturity date, and on that date we will receive the total principal of the note and the total interest due. Notes do not involve periodic payments. Notes receivable contrasts with accounts receivable in two important ways. First, a note is evidenced by a formal written agreement. Second, notes involve interest. There are two parties involved, the payee and the maker. The payee is the party that initially provides the benefit. The benefit can be either the payment of cash or the settlement of an accounts receivable. Settlement of an accounts receivable simply means that the payee has a customer that owes on account, and they decide to allow the customer to switch from owing on account to owing on a note. The main reason why a customer would want to make this switch is because notes normally allow for a longer time to pay. The note is a notes receivable to the payee because once the benefit is provided, the payee is owed money from the maker. The payee will receive the payment of principal and interest on the maturity date. The interest earned on the note will be interest revenue to the payee. The second party to a note is the maker. The maker is the party that initially receives the benefit of cash or settlement of an accounts receivable. The note is the notes payable to the maker because once the benefit is received, the maker owes money to the payee. The maker will make the payment of principal and interest on the maturity date, and the interest incurred is interest expense to the maker. Here is a visual depiction of the relationship between the payee and the maker. The payee gives the maker either cash or settlement of an accounts receivable, and in return the maker gives the payee a note, which represents the maker's promise to pay the payee the principal and interest on the maturity date. Our focus in this chapter is the payee's perspective because we are learning about notes receivable. We will learn about the maker's perspective in a later chapter. One topic of great importance when learning about notes receivable is the calculation of interest. We learned the formula to calculate interest in Chapter 4. The formula is principal times rate times time. Remember from Chapter 4 that the interest rate provided is always an annual interest rate, so we use a time factor to essentially calculate the interest for the particular time period. The denominator will either be 12 for 12 months or 360 for 360 days. If the note has been outstanding for full months, then we can use 12 as the denominator and the number of months that have passed as the numerator. If the note has been outstanding for only a portion of a month, then we must use 360 as the denominator and the number of days that have passed as the numerator. We use 360 instead of 365 because in the days before calculators, it was easier to divide by 360 instead of 365. Even though we have easy access to calculators today, we still use the 360 denominator. Now, let's look at the journal entries related to notes receivable. When the note is received by the payee will debit notes receivable to recognize the note and credit either cash if giving cash or accounts receivable if giving a settlement of accounts receivable. If a period end falls before the note matures, then we must accrue the interest revenue earned on the note. The entry would involve a debit to interest receivable to recognize the fact that someone owes us interest, and a credit to interest revenue to recognize the interest revenue that we earned during the period. When we receive payment on the maturity date, we would debit cash for the total cash received, and we would credit notes receivable for the principal of the note. If we have not accrued any interest revenue, meaning the note matured before the period end, we would credit interest revenue for the total interest earned on the note. If we have accrued some interest revenue, meaning that the note matured after the period end, then we would credit interest revenue for the interest earned in the current period and we would credit interest receivable for the interest accrued in the prior periods to remove the receivable from the books. Let's look at an example. On September the 1st, ABC Corp makes a loan to XYZ Corp and accepts a $10,000 6-month 12% note. In this example, ABC is the payee and XYZ is the maker. Therefore, we are taking ABC's perspective. On September the 1st, ABC would debit notes receivable and credit cash for $10,000. One thing to remember is the entry to record the receipt of a note never involves interest. We do not earn interest until time passes. This note is a 6-month note, meaning that XYZ will not pay anything to ABC until 6 months pass. At that time, XYZ will pay ABC the entire principal and interest. If we assume that ABC prepares financial statements annually, we must accrue the interest earned on the note at December 31st. We will not receive payment until March 1st of the next year, but we have earned the revenue in the current year, so we must report the revenue in the current year. Before we prepare the entry, we must first calculate the interest. Remember, the interest calculation is principal times rate times time. If we plug in our numbers, the principal is $10,000, the rate is 12%, and the time factor is 4/12. We use 12 as our denominator because the note has been outstanding for 4 full months, so we are dealing in full months. If the note had been received during a month, then we would have to use 360 as our denominator. It's important to note that even though this is only a 6-month note, we still use 12 as the denominator because the interest rate is an annual rate. We use 4 as our numerator because 4 months have passed since the receipt of the note. All of September, all of October, all of November, and all of December. When you do the math, you get $400. ABC has earned $400 of interest revenue on this note. In the entry, we would debit interest receivable and credit interest revenue for the $400. Please note that we do not debit notes receivable. Notes receivable is reserved for the principal of the note only. We have a separate account for interest receivable. We will receive payment on the maturity date, which in this example is March 1st. We must first calculate the total cash received, which again is total principal and total interest. The principal is $10,000 and the interest is $600. The interest is calculated by using our formula of principal times rate times time, or 10,000 times 12% times 6/12. We want to calculate the total interest that we will collect, not just the interest for the period. It's a 6-month note, so our numerator is 6. We debit cash for $10,600, and we will credit notes receivable for the principal of $10,000. We have accrued $400 of interest in the prior period, so we would credit interest receivable for this amount. Finally, we would credit interest revenue for the revenue earned in the current period, which is $200. This is calculated again by using our formula of principal times rate times time, or 10,000 times 12% times 2/12. The 2 in the numerator represents the 2 months that have passed in the current period, all of January and all of February. This completes Part 3 of the Chapter 8 lecture series on Notes Receivable. Have a great day.